Okay, how you doing, folks? Ordinary Income back today. I found another article I want to talk about, and I think I'm just going to keep sticking to this method of like finding some news and then kind of giving the economic breakdowns rather than vice versa here. So in this one, something I saw earlier today, it was just the Bloomberg talking about mortgage rates rising, and it was something I saw all over Twitter as well, that we've seen like the highest mortgage rate since 2019, and some pretty baffling numbers overall. In particular, I want to break down what the costs look like, because I know in this article, and I'll leave a link to this article, they do talk about that, but it doesn't include the price of inflation as well. But in particular, when we take a look at mortgage rates, the number I think is the highest since 2019. It's at 4.42%. But the rate of increase has been ridiculous for the time span. We kind of had this low right here in January 2021 at 2.67. And you see a 66% increase. The last time we ever saw a 66% increase, I don't know. So that rate of change is pretty ridiculous, meaning that home buyers have most likely seen increases in costs. And what caught my eye was this tweet right here talking about how with these mortgage rates increasing, mortgage companies are laying off thousands of people because you don't have as much demand when rates are higher. Refinancing is down. Oh, and on top of that, if you are a new home buyer, you're still paying the cost for inflation, food and gas as well. And now you're having higher rates on your mortgages, meaning that if you're somebody who's looking to become a new home buyer, everything's going to be costly, more costly than it was a year before, and just the highest cost it feels like in the history, definitely of one's lifetime, with everything around you and now including your home. Usually, housing has been a great thing. You buy a house, you hold on to it, maybe even rent it out to get some more cash flows, but your property, the value of your house is something that's tied a lot to American wealth. The only problem that people don't seem to account for is that the way that you build that wealth is that you have to buy a house at low prices. The houses right now aren't at low prices, and it depends what kind of frame you want to look at. Do you want to look as an investor and say, okay, I want to buy houses at low prices? We don't have that yet. But then there's the opposite side of the typical American family, that you need a place to stay no matter what. So, the housing costs could be as expensive as you want, but people still need a roof over their heads. And so a lot of people that are buying homes, whether it's a family-oriented situation, you're getting trapped at high prices and high interest rates. So let's take a look at that interest rate in particular. Well, actually, before I do that, what goes into the interest rates? This article here talked a little bit more about mortgage-backed securities, which I did a video. But mortgage rates overall, what I've seen, and we can look into more so what impacts mortgage rates. From what I noticed is that it's not really anything in the consumer's control. Bank rate, all right, we'll see what happens. But it's not really anything in the consumer's control. A lot of it is most of it's actually outside of our control. Complex things. And the Federal Reserve is one, so the federal funds rate, most likely, even though they don't set mortgage rates, I think the Fed funds rate plays a role. Economic conditions, inflation. Your picture, cool. But the biggest ones, the top three: inflation, not under our control; economic conditions, not under the consumer's control; and whatever the hell's going on with the Federal Reserve, not under your control as well. So what's impacting them is things that the consumer doesn't really play a role in, but they're the ones suffering the cost. So let's take a look at how this interest rate really impacts the consumer. We're going to use it from 2021, the low, because I'm going to cherry pick, at 2.67 and the high at 4.42 right now. All right, so you have a loan, 267. Okay, so you have a $100,000 loan. This is not the value of the house, it's just the loan you're taking out. I will leave links to mortgage calculators, by the way, but let's say you do have a $100,000 loan, because we're doing round numbers. 2.67%, 30 years, we make a payment every month like usual. Your monthly payment's $404. By the end of this $100,000 loan, at the end of 30 years, you will have paid back, obviously, this $100,000 loan, but also $45,445 on top of that, which is the interest. Why are you paying interest? Well, that's how banks work. You don't have this $100,000. You're taking a loan out. That's money that the bank is loaning to you in order for them to make money to replace the fact that they don't have it. They charge interest on it. There you go. Easy stuff. It's the cost of doing business, more or less. but you're paying 45. So if we really want to do a total, we can right next to it. And this is what you would end up paying back in total, your loan plus your interest rate. But your monthly amount that you're paying is $404.02. All right, that's a 2.67%. Watch what happens when we go to 4.42. Now you end up paying $80,000, almost $81,000 as opposed to $45,000. Your monthly payment went up to $501.94. So you have 404.2. So you what 502 divided by 404. And what I did there was simply just take the monthly payment that you have when you have a 2.67%, compare it to at a 4.42%. So 502 divided by 404, you're paying 24% more monthly when you have this interest rate change, which is why no one's refinancing, because that's a stupid idea. But you're also paying, you had about 145,000, 500, let's say. And this was this 145,000 was at the 2.67%. So now at the end of your 30 years, you would have paid 24% more as well, which makes sense because you're paying 24% monthly. You're paying 24% more overall on the total loan when you include how much you have to pay back, the 100,000, as well as how much you're paying to borrow the money, the interest, 80,000. So that's the cost of what it looks like when mortgage rates increase. You see the overall cost increasing. It doesn't increase by, we had 2.67. It's not a straight increase of 4.42 minus 2.67 to get you like that 2 point whatever. Oh, it's a percent, that's why. 4.42. It's not as easy as this of 4.42, so you're minus 2.67, so you're only paying 1.75% more. It's actually more, not even like that, but it's more of a comparison of total dollars being spent as well. But this is only if you're looking at $100,000. What if you were to say, okay, I had a mortgage rate increase, but the house I wanted isn't $100,000 anymore I'm taking out, it's $120,000 when you take into account inflation. In particular, you've seen some headlines that saying housing has gone up 10%, 15, or even 20%, but it's been double digits. So let's say it is 13%, because I've seen that number around. And so now if you include inflation on the house you were looking to buy, now you have to pay $113,000, 2.67, so 4.42. Look at how much now you end up paying over the course of 30 years because inflation impacted your house, interest rates increased, and so the total amount you're paying is $204,000. If we do a simple division, you've ended up paying 40% more overall when you include inflation as well as that mortgage rate interest increase. So that's how it really hurts the consumers. You end up paying more money. Most of the cases, it's money that we really don't want to pay or have a tough time kind of scraping along with when you include the fact that we've had to pay for a lot of things like gas, food. The necessities are really starting to boggle people, and taxes aren't getting any easier. But inflation's hitting everywhere, including housing, and now interest rates are going up as well. So how does it impact the consumer? The idea is with higher interest rates means a higher payment, means that there's less demand. Less demand means lower prices typically. Is that going to happen? I don't particularly know. I mean, this thing will take, it doesn't happen overnight. It takes a little bit of time to kind of catch up and see will we have lower prices coming. That doesn't necessarily indicate that we're going to have a crash by any means. I think that's a little bit too much head of steam right there, but this might be some relief for people looking to at least buy homes to get into prices that aren't ridiculously inflated. Of course, there's other factors in the housing market, in particular the certain buyers, but maybe this will start to be the first indication that housing prices are starting to get cheaper. I don't know, but as we just saw, there is an impact to the overall payment you'd be making, meaning less money in your pocket, meaning you're going to not be able to afford the things you most likely want, just because you're still going to buy the things that you need. But that's all for today. I'll leave all the links to the article, the mortgage calculator, and all that. Let me know if you guys have any questions, any comments or concerns as well. You can drop them in the YouTube video or on Twitter. And have a great one, folks. I'll be back on Monday making some videos about some new things I see. And hopefully you'll enjoy. And hopefully Duke loses on Saturday. We can only hope. So enjoy, folks.